Hello everyone, welcome back to the Algorithmic Advantage. Thanks so much for joining me. It's the 8th of October 2023. If you are enjoying the content and you know someone else who'd enjoy the show, hey, please share the show with them. We'd really appreciate that. Today we had the extreme pleasure of chatting with Art Holly. Art is a quantitative trader with 30, 40 plus years of experience and a wealth of knowledge to share. So it's a long show, but every minute is incredibly valuable. Listen to it in parts if that's what you need to do. Just some of the things that we covered in today's chat real quick. His experience as an allocator. Art worked in allocating client money to other funds, and he got to analyse in detail a great many funds over many years, and he picked them apart and worked out what made them tick, what he liked, what he didn't like, and he incorporated that into his own strategies. We talked about new technology and AI and how much does that help the big end of town. What is that delivering for them return-wise? And of course, I was interested to know how can the newer trader compete. It doesn't matter at all. We talked about his ensemble of systems and the many ways as he uses to extract edge from the markets, and how he creates an all-weather portfolio that has truly delivered over 30 years with an incredible track record, and we talk about that in the show. He talks about positive skew and not warehousing risk. They are important considerations, so listen out for what all that means. Art trades short-term and long-term models. He trades equities, he trades futures. He even trades market profile in a quantitative way. So market profile or auction market theory is a system and a methodology, a philosophy that was dear to my own heart when I used to trade futures as a discretionary trader using that technique. And Art is the only guy we've ever met who has quantified those systems and been able to make a systematic trading strategy using market profile. So if you know anything about market profile, you know that's really unique and extremely interesting. So Art has a rich experience. He's learned from all the best personally. He drops names like Van Tharp and Ed Secoda and the Turtles and Pete Stadelmeyer, William O'Neill, and of course he has worked for Man, for UBS, Bank of America, and managed his own funds, and now trades private money for managed accounts. So if you want to reach out to Art, you're welcome to. You can ping him or follow him on X/Twitter on ArtJHolly3. That's at ArtJHolly3. And of course, you can also reach him on LinkedIn. He's happy to chat with you there. LinkedIn.com/in/art-holly. Enjoy the show.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Hi Art, hi Rich. Welcome to the show. Great to have you guys here.
G'day, Art.
Hi, guys. Thank you so much for the invitation. I'm very excited to be part of the program.
We're super excited to have you here. We think you're as enthusiastic as we are at talking about quant, and the whole history and your history. We're super excited to get into that and understand your pathway. Your history is very interesting. You've had a lot of experience, and we'd love to go through all of that. And then, of course, we'd love to get into how you're trading today, the strategies that you use, your philosophy, and so on. So if we launch straight into it, Art, do you want to give us that history and take as long as you like and pad it out as much as you like, but give us a bit of the walk that got you into trading, some of the lessons learnt and the highs and the lows and the mentors and what you'd do differently and so on and so forth as you walk through your history in all things systematic trading.
Wow, that's a tall order. I think we may be here for the next 4 hours, but I'll give it a whack. So I started my career straight out of college. First employed by Union Bank of Switzerland, UBS, back I think when the dinosaurs roamed the planet during the mid '80s. And it was funny because when I joined, majority of the guys in New York were all fundamentalists. I remember my boss telling me, "Go read the teller rate, and you'll figure out, what's going on in the market." And I'm looking at him like, "What the heck are you talking about?" I was the only guy on the floor that knew how to program a computer, so started to do some really cool stuff like ARB, the Eurodollar strip, and ARB things like forward rate agreements, because we used to trade a lot of those. And one of the guys on the floor started talking about this guy by the name of Pete Stottlemyre, who was doing something interesting out in Chicago. He came up with this new concept called market profile, or auction theory. So one thing led to another. They shipped a bunch of us out in Chicago. And I remember the first day I walked out on the floor of the Board of Trade, and it was like a fish finding water for the first time. It was like, oh my God, this is where I belong. And the conversations that the guys in Chicago down on the floor were having were about odds, risk units, and payoff profiles. And they thought about it in a very systematic fashion. And that just, to me, just made a lot more sense to kind of how to think about markets, and kind of was the spark that actually drove me into the technical
more interesting world than the stuff the fundamental guys were doing.
Yeah, absolutely. Growing up, my dad was a big poker player, so we used to play poker all the time. So I always thought in those constructs in terms of odds, risk units, payoffs, and how to think about
Survival.
it. So it was a natural fit. So wound up learning a lot about market profile in terms of how market...
Art, can we just quickly go into what is market profile, just for our listeners?
Yeah, it's a different way to actually organize price data. So to Stottlemyre, the market is nothing but an auction mechanism. So you have three parts to it. You have price, which actually is the auction system, which wants to auction high to low to bring in as many market participants as possible. The way you structure the price data, you wind up having time regulating the opportunities that are out there. And then the third part of the component is volume. Volume either confirms balance areas where volume actually takes place, or excess price areas. And it really boils down to going back to the first step. What's the true purpose and what's the true nature of why markets exist? And it's all about, to Stottlemyre, the way he answered is to facilitate trade, to find price areas where trade can actually take place in two-way areas. And it's just a very unique way of being able to take price data, stripping time out, the way most people kind of look at 30-minute or 60-minute bar charts, and just looking at the data from a different lens.
So this produces a totally different visual chart. So that most people are used to with their open, high, low, close across time. This is a different form of chart visualization.
Correct. At the end of the day, it actually forms a variation of the bell curve. Because what prices are doing is they're actually going to auction higher. They're ultimately going to cut off buyers and bring in sellers. And then prices are going to auction lower, and they're going to cut off sellers and bring in buyers, right? So call it the third standard deviation on both sides. That is the time regulation, the opportunity to take advantage of really high prices or low prices, and is pretty much instantaneous, whereas prices kind of settle somewhat in the middle most of the time, where lots of trading can take place and where participants can basically buy and sell at a kind of a value area.
I had my library here, Art. I could pull out his book, Markets in Profile, I think it was called, wasn't it? But it was a dry read, I've got to admit. But I loved trading market profile when I was a discretionary trader. You basically end up rich with a histogram on its side, really, don't you? So you've got the areas from the high to low where the most of the volume is traded, and then you've got areas where there's less volume, and that value area is the area where most of the volume is traded.
So Pete was brilliant. He was not a great writer. So when you read Pete's material, you were pretty much lost. The baton was picked up by a couple really good writers. Jim Dalton actually wrote one of the better books out there about market profile. And then there's a couple books written by Mark Fisher, who is one of the biggest locals down on the NYMEX, who kind of took the baton as well and kind of made his own variation of market profile and talked about auction theory. But it was the combination of thinking about how markets are structured, being down on the floor, that has given me a huge edge in terms of how I think about how markets distribute themselves, how prices are either in a rejected area or in an excess balanced area. And it's been instrumental in terms of how I look at the markets and how they basically auction. It's taken a long time to figure out how to make that systematic, but it was part of the journey in terms of just differentiating my thought process of having that experience down on the trading floor versus other people who just never had the opportunity to be there. And so it's imprinted me in terms of my philosophy of how things work.
Yeah, I really
and as
sympathize with that.
as Van Tharp, who is one of my mentors, basically say, we don't trade the markets, we trade our beliefs about the markets. So it kind of falls into that realm. So
It was sad to hear that Van passed away just quite recently, really. It was there was some magnificent work done by him on position sizing and risk management.
I would say that out of anybody that I've ever crossed paths with, Van probably had the most impact on how I think about things, especially on the risk management, position sizing. He was just a true light. He was just a really phenomenal individual, phenomenal human being, and did a lot for me in a whole bunch of different ways.
Wow. Well, let's not jump to that. Let's come wherever that comes in the story. But
Sure.
after you went down to Chicago and you were thinking market profile, where did that lead from there?
Yeah, so Pete invited about 20 guys every year to a cabin up in Butte Meadows, California. It's way north of Chico, California. It's up in the Sierra Nevadas, and it's God's country up there. 20 guys, and went very excited because you're getting a PhD in market profile and how to think about all that stuff. And I guess he had like 5 or 6 cabins, and we had one main trading cabin. We had to get up at like 4 o'clock in the morning and get our flashlights on and walk through all the woods and hear, cougars and mountain lions all around us, and wound up actually getting to this trading cabin. One of the guys that was there was a disciple of Ed Seykota, who just happened to sit next to me one year. We formed a really quick, fast relationship. And he started to brainwash me in the ways of Ed, trend following, and something very, very different than I had ever experienced before. And so he also introduced me to a good friend of his who I ultimately went to go work for after I left UBS, who was another disciple of Ed's, but was also a student of Van Tharp. So that's actually how I got to Van as well. So one thing led to another, and I was going down to see Van probably every 3 months or 6 months, and just trying to be a sponge and soak as much as I could out of every second I could spend with Van. And one weekend there was a gentleman by the name of Howard Seidler that was sitting next to me at Van's, and Howard was a turtle. And so I quickly formed a great friendship with Howard. Again, I miss Howard. Howard passed away a few years ago, but Howard introduced me to Curtis Faith and Russell Sands and Liz Cheval and a bunch of the other turtles, and one thing led to another, and I was getting fire hoses from all kinds of directions in terms of trend following, and I was just being completely brainwashed in thinking that way. So it was fantastic. It was fantastic.
What an opportunity! Yeah, what a lot of
I'll pause there to see if you guys have any questions about that.
I'm just jealous.
Well, I was wondering how you missed that ad in the Wall Street Journal. Maybe you should have been a turtle.
Yeah, I was still in college, unfortunately, in 1983 and 1984. One of the things that was always interesting about that experience is the fact that when new traders come onto the scene, they think that it's a simple equation. You have your system, you have your risk management, and you have kind of this emotional dashboard that you have to deal with, right? I think most people think the ratio is 60% systems and 30% risk management and 10% kind of emotional. What I came out of that experience was the fact that it's completely upside down. The fact that, Ed would probably say it's 100% all emotional, because when you think about your framework of the research that you do, the type of research that you do, the motivation of doing research really drives what kind of systems you ultimately come up with, both on the call it the trigger mechanism, the entries, the exits, plus the risk management. And he would basically say that the systems are probably the least relevant out of the entire thing. So you've been in the business long enough, you actually come to the realization that most people have it upside down. And the emotional part is much more important than what kind of systems you design or the risk management systems that you have. So that was the lessons, some of the lessons that I learned from these mentors that I had.
Yeah.
But probably the best mentor that I had was down on the floor of the Board of Trade. Probably my second or third day there, and I forgot the guy's name. It's kind of blurry. He basically said, "Kid, if you're going to last in this business, you got to learn to be a great loser." And I looked at him like, "What are you talking about?" Because you got to take lots of small losses, and you have to enjoy losing, because if you don't, you're not going to last in the business very long. Fast forward a couple of years into the future, when I wound up, being brainwashed by Howard and some of the guys that came out of Ed's group. They were basically saying the exact same thing. So it all kind of fit together in a puzzle. Awesome.
All right, and just keep it rolling, Art. Where to from there?
Yeah, so I left UBS. I went to go work for an equity long short fund. So at UBS, we basically had three different desks there. We had a fixed income desk, we had a gold desk, silver, call it a metals desk, and an FX desk. So
about what year was this, Art? Where are we sitting?
Yep, in the mid to late 80s.
Okay, yep.
So then went to go work for a friend of mine who was running an equity long short fund. I wanted to learn all about equities. He was the gentleman that introduced me to Van and was also good friends with Ed. So I got to get a lot of knowledge from that experience. And I quickly learned the fact that I could probably do a better job than those guys. And so in 1992, I was young, naive, and stupid, and decided, okay, why don't I go start my own hedge fund? So started probably one of the first systematic equity long short funds back in 1992 with a partner. It was a little different. My partner was much more fundamental based. I was the quant, especially when it came to risk management. For the next probably 8 years, we just hit it out of the park. We annualized out at about 28%. We had a 10 vol. It was really a nice combination of what we did. unfortunately, we just couldn't raise a ton of money because quant wasn't sexy at the time. Everybody was really excited about Julian Robertson and the Tigers and concentrated fundamental long short guys, and we got to about $100 million at the time, and it was a tough slog trying to go out and raise money at the time. So we did that until we got a very large carrot thrown at us from Bank of America to come in and run a prop desk. So
before you jump to the prop desk, what kind of strategies? I'm just curious. What kind of strategies were you trading at that time in equities? What took your interest back then?
Yeah, so we were basically taking a lot of the fundamental inputs that my partner was thinking about, and then just basically putting a technical overlay on in terms of where we thought we had a statistical edge in terms of entries, in terms of getting out, how we size things. I just remember walking into meetings with potential clients and having them listen to me about how I talked about risk management and position sizing and how we had a statistical edge getting in things. They would look at me like I had 10 heads. I was just, the usual comment was, "You're a CTA, but you're trading equities." Like, yeah, it's risk is risk. That's how we thought about it. And so it was a difficult story for a lot of people to understand versus the tiger cub that would come in after us and basically say, I have a hunch I'm going to bet a bunch and put 25% of their portfolio in one name. We didn't think like that. We wanted to be diversified. We wanted to basically understand the risk in our portfolio, and we just looked at it much more from a CTA perspective from that. So we were very
fundamental underpinnings, but your trade activity was defined by quant methods, basically.
Correct. Yep.
Okay.
And I guess that what you've said there highlights that some of the difficulties in attracting AUM are such a marketing issue and having the right story. So that's, in some senses, unfortunate, isn't it? It makes it difficult.
Yeah, it is. So fast forward, I've been fortunate enough to sit on both sides of the allocation table, and I always had this model in my head when I start to do due diligence on managers. I kind of think about 6 different buckets and defining them and trying to get a lot of clarity on how managers think about it. And one of them is the first bucket is really clarification on the universe that they like to go fishing in. What kind of instruments, what kind of regions, what kind of market cap, so on and so forth. The second bucket is really trying to understand how they think about creation of a watch list, what they're looking for, both on the long side and the short side, what attracts their interest in certain opportunities. It's the narrative of the story. Finding a bubblegum company in Tibet who's trading at a 2 PE or some crazy thing like that. The third bucket is basically the trigger that gets something from the watch list into the portfolio. Then the fourth bucket is it's in my portfolio. Oops, it goes against us. It goes against me. How do I actually take a loser? The next bucket is, oops, it's in my portfolio. It goes my direction. How do I monetize that? And then the last bucket is all about position sizing, risk management, portfolio construction, so on and so forth. And it's always interesting, the fact that majority of people like to basically stall on one of those 6 buckets, and it usually is the narrative. People are just fascinated by the narrative of the story.
That's the sexy part.
That's the sexy part. Whereas to me, and the people that taught me, the sexy part is buckets 4, 5, and 6. How do you get out of a loser? How do you monetize winners? And most importantly, it's all about position sizing, risk management, portfolio construction. That's the sexy part to me, as opposed to most people. And I think that's a problem with most quants, the fact that there's not a sexy story involved in it versus a concentrated long short guy.
Yeah, absolutely. Okay, so then you moved into the prop trading arena.
So then, so we were at B of A. I think there were 10 different prop desks there. We were consistently either the number one or number two for 3 years, which we were excited about.
What instruments and contracts?
It
were you
was
trading
pretty
in?
much the same strategy that we traded when we had our fund, which is basically U.S. focused equity long short. And this was during the 90s and early 2000s. And what the bank B of A wanted us to do was to transition to become a risk arbitrage group. I knew as much about risk arbitrage as Mickey Mouse did. The fact that it was not what I was good at. I had no interest in it, and it was the furthest thing from how I thought about the markets in terms of how I was taught. So I decided to leave the bank and look for new ventures. At the time, what was interesting, a good friend of mine had just left Credit Suisse, and he was about to take over and build out a $25 billion fund of funds unit at Merrill Lynch. He said, why don't you come over, take a break from trading the markets, and you can be an allocator, and let's go find some good managers to put on the platform. So I did that. I thought it was fascinating just due to the fact that now I got to see how other people did what they were doing. At the time when I got there, John Paulson was just starting to put the trade of the century on. I think we pumped about $6 billion of AUM into Paulson. I got to sit with John, became somewhat friends with him at the time, and it was just fascinating to see what people were doing. And one of the things that always struck me about reading books like Market Wizards is the fact that there's always hundreds of different ways to make money. It's just not me sitting there with blinders thinking that my methodology is the best. And that really came true to when I was at Merrill. One of the negative things about being at Merrill and allocating to John Paulson was the fact that I understood how much trouble Merrill Lynch was in, and I knew that I had about 8 torpedoes headed right towards them in terms of what was in their portfolio. So an opportunity came to go to Man Group and become head of portfolio management for Man, for North America, and actually for Australia as well.
Mm-hmm. Okay.
So went and made that transition. Similar role. What was really interesting, the fact that Man had a large managed account platform, and part of the process of doing due diligence on managers and monitoring what managers are doing is the fact that we got to see real-time data of probably 60 of the top managers out there.
Yeah.
And I felt like a kid in a candy store because now we could go back and re-engineer what managers were doing, or try to actually re-engineer what managers were doing, which was absolutely fascinating. And so that was phenomenal. So
was this, you're talking about replication here, Art?
No, it was not really replication. In my own head, it was replication, but it was really more from a risk management perspective of what we were trying to look at and understand exactly what the manager was doing, how he got into trades, how he got out of trades, how he positioned the trades, how he built the portfolio around all the line items and what kind of exposure he had. Having this managed account platform was fascinating because we could basically wrap up the entire portfolio and look at it from any different asset class from a convexity perspective.
Yeah, it makes you feel like a kid in a candy store. I get excited with allocation.
So how many funds did you get a chance to look at? Let's talk about this a little, Art, because this is fascinating. I mean, how many funds were you looking at over what period of time, and what degree of unpicking did you do, and how did you learn from that?
So we had about anywhere between 60 and 100, because over a 7-year period, we wound up redeeming managers, putting new managers on the platform. The platform was growing. So we'll call it in total maybe 100 managers that went through. A great story, good example of kind of just the learning process. We wound up seeding a large manager, or a manager that was number 2 or 3 at at a very famous equity long short shop, and I won't name I won't name them, but he had a stellar track record, and I think it was in 2011. And what we found was the fact that he, when we were looking at the data, he started to martingale all his positions. So he would buy 2,000 shares of AMD, and it would go 10% against him. He'd double up, and it'd go against him some more, and he kept on doubling up. And for the longest time, he was able to avoid the Grim Reaper just due to the fact that the market's bailed his butt out. But in 2011, they just never did, and he winds up blowing up. But winds up leading me down the intellectually curious route of how managers actually create those smooth return streams. And I like to say that they cheat just due to the fact that they wind up doing some unique things, whether you're a distressed manager and you mismark your book just due to the fact that your holdings are illiquid, or you wind up basically selling premium, and you create kind of this negative convexity in terms of the overall portfolio of what you have. You have guys who create that same type of behavior by actually trying to sell highs and buy lows, because eventually you're going to get run over on one side. You guys have people that martingale; they keep on doubling down. There's a whole host of reasons, and the final one is basically you're Madoff and you're a fraud, which kind of falls into it. But leading us down the research path of actually understanding autocorrelation and smoothness, and understanding, and this is one of the topics that I love when Rich talks about it, is warehousing risk and understanding how managers warehouse risk and how that can lead to really nasty outcomes when the chickens come home to roost. So
explain that a little more, maybe, Art, for some of our listeners and viewers. Warehousing risk.
I'm going to actually turn that over to Rich in terms of how he thinks about it.
I think there's a good expression by Corey Hofstein that risk can't be eliminated, so it can only be transferred. So unless you exit a trade or exit your position from a trade, there's always risk somewhere that lies in that trade. Now, many portfolio managers use the trick. It's a bit like an old accounting trick of window dressing your accounts at the end of the year. What they'll do is they'll transfer their risk about the portfolio to make it look smooth, but hidden in that portfolio is this building risk. So when we look at individual return streams in a portfolio, each of them carry a particular level of risk. When we combine those return streams together, the risk is still there, but it's just being offset. So the portfolio in a net risk position looks as though it's not carrying much risk, but the risk is still held by each of the return streams, but just being offset by those return streams. So a lot of portfolio managers have learnt the art of transferring that risk around the portfolio to keep that that extrinsic risk of the portfolio looking low, but held within that portfolio as this extrinsic risk, or this intrinsic risk, which is huge, which is warehoused. And so you'll see that these portfolios last a long time with this apparent, very lovely straight linear equity curves, great sharp ratios, everything going well, but it's not recording the warehoused risk that is actually in the portfolio. And you see that can explode when the regime shifts into what we call these massive negative skew events, what Art's referring to as the negative convexity. We see this massive explosion in negative convexity. It might not be apparent for many years, but it's there, it's being warehoused. So that's why we use the term warehouse risk. It's sort of a hidden risk. And unless you're prepared to take risk off the table by what we call releasing risk steam from the portfolio using exiting trades or stop measures, etc., in your portfolio, that risk is still retained in the portfolio. It's just where it lies in that portfolio. Does that explain it, Art?
Yeah,
you're happy with
it? And we see a lot of that in basically, like I said, distressed managers who mark their holdings to Fantasyland or model until you get a 2008 type of environment where your prime broker starts knocking on your door and needs you to basically reprice it, and you wind up finding yourself down 25% because you have to reprice it. Or you see it in a lot of mean reversion guys who wind up expecting markets to mean revert, and there, as Rich would say, there's a massive regime shift, and your mean winds up repricing itself down 20%, and you see that. That's why the vast majority of hedge fund strategies have negative skew and a big left tail to it. So you just see that all the time. And we can talk about this, later, but one of the key tenets that I wanted to build in my portfolio was to have a positive skew, which is really seems to be rare, especially in equity long short land. So a lot of those experiences that I had from Man were really more enlightening from what to do, and even more importantly, what not to do in terms of how to think about building portfolios, and why so many managers wind up, just having such poor performance. So I wound up leaving Man, and I became a partner in a multifamily office, which was kind of interesting. We had about 15 families. We built a really unique managed account platform that we actually wound up selling to InvestNet, which is a publicly traded company based out of Chicago. And after we sold it, I looked at my then partner. I said, I really want to get back in the game, and I want to start my equity long short strategy up again. And part of it was a little bravo on my part, because I said to him, I think I could trade rings around most of these guys. Because as an allocator, I was always disappointed with majority of equity long short managers. I think on the whiteboard, most equity long short managers were supposed to deliver 60% of the upside of the S&P with 40% of the downside. But it just seemed that in reality that it was upside down. It was 40% upside capture with 60% downside capture, with a big left tail, sharps less than one. And I just felt with my background and how I was taught and lessons learned that I could actually build something better. So we launched it in November of 2016. And it's been basically running now for about 7 years. At the end of 2019, my then partner was looking to either sell the business or retire. So I decided to move on and start my own fund called Breacher Capital, which was great. I was very, very excited about that. I underestimated how difficult it was to actually go off and launch a hedge fund and raise capital, and it's just brutally difficult, brutally competitive out there. We tend to be very different. We had a very different story than a typical long, short, concentrated fundamental story. And so after a couple of years, we raised, $30-40 million. I reached out to an old friend of mine who ran a multi-strat at Teza, thought that would be a great fit. After close to a year there, it just didn't seem like it was a great fit, just due to the fact that they historically came from a DNA of low latency, which is something that we really weren't. And they were trying to figure out what to do with us. And so decided to leave. And so wound up running a bunch of managed accounts right now, running the same strategy. So I'll stop there to see if you guys have any questions.
Well, you say it took some bravo, of course it does, but through the whole course of that period, in and out, you've always been doing your own trading, and I've heard you've had 30 plus years of positive returns, so I think you've been doing something right. Is that right?
So I was having a conversation with my wife the other day, and I was like, I'm looking back on my track record, and when I was at UBS and when I was at B of A and when we had our hedge fund and when we had the new launch of the hedge fund over the last 7 years, I actually was shocked at the fact that I never had a down year. Like, it's really unusual. So
let's get this straight. We're talking how far back? 1989 to
like
now? Are we talking?
Like 19. I'm sorry to say, I actually traded during the 1987 crash, which is a good story in itself.
Please tell us a little bit about that too.
Yeah, so at the time I was trading the short end of the curve. If you guys remember at the time, what was happening prior to the crash was the fact that the short end, bonds, everything were in a pretty massive downtrend. And I wound up, and I literally at the time, I was just learning what the difference between a bid and an offer was, I felt like. Everybody around me was the fundamentalists, and I kept on thinking, okay, this thing's got to bounce somewhere. And I wound up getting my book to the point where I was trying to buy the lows all the way down. And the crash happened, and Greenspan actually cut rates, and I walked in the next day, and Eurodollars were up by like 25 handles or something like that, and made a ton of money. And I looked back, probably 10, 15, 20 years after that, and was like, that was completely wrong trading methodology.
Averaging down all the bad things.
Yeah, no, I don't remember. Unfortunately, I was still learning my times tables in '87. But yeah. So
so I lucked out, when I was young, brash, and stupid. But it turned out okay. But if I had to do it again, I would have been short going into that whole process.
So back to your core strategy. Effectively, from 1989 up to current, you don't think you've had one bad year. So really, this sounds like your strategy has been more stable than your career path.
Yes, yes, that's true. It's sad to say that's true. Yes, something that Ed Seykota once said: the fact that what we can deem as constant, the fact that markets are always going to change. And so I always scratched my head when I used to get around a bunch of quants. They basically say, the markets are different. Markets are different. And that just never made any sense to me. The fact that markets are always going to change, you need to build a system that's going to be adaptable, to be able to change with it. And so that was really one of the cornerstones that I was taught early on, to build something that adapted with how the markets change. And I always always was confused by the fact that people would build a model and the model would be thrown to the junk pile 6 to 9 months later because it stopped working.
Yeah.
That just never made any sense to me. So I built something that I wanted to basically knock off a whole bunch of boxes. I wanted it to be absolute return. And truly absolute return, because a lot of people call it their product absolute return, and they'll be down 20% during a bad month. So I wanted to be pretty consistent on that. I wanted to be pretty consistent in terms of being in top performing decile. If I did that consistently, I'd probably be one of the best. I wanted to basically have low drawdowns. I wanted to be able to have great ratios, whether it's Sharpe, Sortino, MAR ratio, whatever way you want to look at it. Wayne likes to look at skew adjusted Sharpe, which is the way I like to look at it.
Now, when we're saying Wayne, we
Wayne Himmelstein, who's a mutual friend of ours. And then finally, probably most importantly, I wanted to have a positive skew in terms of the return distribution. So it's kind of like the triple crown that is built. And so that's kind of what I built. It's diversified across directions, so both long and short. It's diversified across time frames. It's diversified across a tremendous amount of equities. So usually our long book has probably about 100 to 150 names in it. Short book's got about 75 names in it. And then we wind up having an overlay structure, which is kind of our third model. And then we just introduced about a year ago a fourth model that I'll call it semi-low latency in terms of how it scalps the S&P market on a daily basis and achieves its objective and basically shuts itself off. So it creates a really unique four uncorrelated return streams that create a very smooth return pattern. It's just very different.
Art, with all of those strategies that you've looked at over time, analysing all those other managers, I know that questions I get this day and age about current managers is how does one compete with the incredible amount of compute power that people are using, the usage of AI, maybe having a room full of PhDs. I think that ties into your comments about strategies that have lasted for a long time versus a short term. But yeah, the question is how does one compete with the extensive use of, say, AI or other technologies that maybe the big guys in town are using?
Sure. So again, one of the kind of fortunate things that is happening now is the fact that I'm running my strategy at the same time. I do consulting for a couple family offices and help them with their hedge fund allocations. So I get to see probably about 500 tear sheets get thrown in my direction on a monthly basis, which is kind of crazy. But feel like I have a bullseye on my back from that perspective. So I get to see pretty much everybody, and I'm trying to absorb as much of the AI mania as possible, and trying to understand how AI is going to impact hedge fund strategies and so on and so forth. I hear a lot of the hype. I honestly haven't seen any positive output of what I've seen so far. I may be missing something, but I just haven't seen the advantage of alternative data sources. Everybody keeps on telling me that it's creating a huge amount of alpha, but I haven't seen it yet. So I'm still curious as to how it's going to impact numbers and how people are going to take advantage of it. So I'm still skeptical out there as I kind of dive into what a lot of people are trying to figure out there. So
if it's not showing up in the returns,
it's not showing up in the returns as far as I could see. It's interesting. I like to call myself an amateur market historian because I go back and look at when we started to do a lot of the analysis on how we build our watch list and our trigger systems. We went back and did about 125 years worth of research on every single stock that's ever traded in the U.S. And this was long before a lot of people started to write white papers about it. There's a great white paper written by the folks at J.P. Morgan Asset Management called The Agony and the Ecstasy, which is an excellent white paper that talks about a lot of this. Some of the research white papers that came out from Hendrik Bessenbinder out of the University of Arizona are beyond excellent. They kind of came up with the same conclusion, the fact that only 10% of stocks are responsible for the positive returns of the stock market, and led me, or confirmed in our research, what we were trying to do, which was to be ultimately outlier hunters in terms of our approach. What I always found interesting about...
I love that term, Art.
I love that term. What I always found interesting about people in the market is the fact that they don't go out back and study some of the great speculators of all time, which we've made it a point to do. Everybody's heard about, or I think a lot of people have heard about Jesse Livermore, who I would consider probably half the best trader that's ever lived and half the worst trader that's ever lived in terms of him blowing out. But he always referred to James Keene as probably the greatest speculator of that time period during the 20s and 30s. So I went back and looked at everything that I could possibly figure out in terms of the the campaigns that James Keene did, and then you kind of roll up into Bernard Baruch, then who I thought was beyond special was Jack Dreyfus, and literally trying to understand and get as much insight as to how Jack Dreyfus actually traded the markets. And then you wind up looking at the Nicholas's Darvises of the world, and then the Stan Druckenmillers, and then Rich Dennis and Bill Eckert and Ed Secota, and another 100 guys behind it. And it wound up leading into understanding some of the, not only the best market speculators, but guys who actually played, whether poker or one of my favorite research projects was understanding Bill Bentor. Bill Bentor is a billionaire, and he was famous for basically cornering the Hong Kong horse racing scene. And it was all done on algorithms and how he thought about bet sizing and things like that. Like that, literally, it just falls into exactly everything that we do in our research. We try to understand exactly how people have done phenomenally well, try to understand kind of what worked, what didn't work, whether it's robust enough. And so it all is part of our research project in terms of how we think about just getting better on a daily basis.
Could I summarise by saying that there are some eternal principles, perhaps, that are true in the market, that are just the nature of human behaviour and human speculation, that seem to stand the test of time, and they work and keep on working?
I think that's spot on. Yeah, I think that's perfect.
What I find interesting, Art, is that, with all of these advanced technologies coming into the fray, I tend to think, with these very efficient markets we're dealing with, where the edge is really slight, and we've just got to capitalise on that. I think that these methods are more a case of over-optimising as opposed to a case of solving for robust trading principles. So, yeah, I tend to agree with you in that I don't see... I certainly can't see it in the returns or in the performance of these highly advanced analytical methods sort of getting any extra alpha than what the speculators that you've referred to before, these very famous speculators have achieved in the past. So, yeah, I see where you're coming from.
I haven't seen it in the numbers yet, and I think my cynical self is telling me that it's just nothing but a marketing play. Yeah. That's kind of my take so far, but I could be wrong. Time will tell.
So now, in today, can you explain this? Obviously, all of these strategies that you trade today are sort of like an amalgam of your career path, your life's experiences. So can you explain the strategies that you're trading today, and what universe are you trading, how are you trading them, what are your risk processes there, how they all fit together as a suite or an ensemble of systems? Can you explain that without giving too much of your secret sauce away?
Sure. And it's truly an ensemble, the way I think about it. The fact that, so there are 4 uncorrelated, very diversified sub-strategies that I utilize. First one is basically just a long only, call it a long to medium term trend following process. Our strategy, typical hold period for a loser is about 1 to 5 days. We kill our losers pretty quickly. Average hold for a winner is probably about 5 months. And then probably about 20 to 25% of the book are those gigantic, beautiful, big whale outliers that we like to sink our teeth into, that just keep on going parabolic and going hopefully to the moon. So they can be.
And aren't all equities? Are we just sticking to equities here in our descriptions?
Yep. So we focus on U.S. equities. The first filter that we do is we take kind of this universe of 5,000 exchange-traded liquid U.S. equities, and we run a volume filter. So we look for things that are trading at a bare minimum of 250,000 shares a day on a 20 ADV look-back period. So it kind of chops the universe from 5,000 maybe to 2,000, the way we think about it. What we found which was kind of interesting, is that when we did the 125 years worth of research, we wanted to go out and find those stocks that were responsible for the big moves. What not only JP Morgan Asset Management Group found out, but what also Bessembinder found out, and what guys like Eric Crittenden found out when he was at Blackstar, was the fact that I think Eric calls it the capitalism distribution. Only about, call it 10 to 15% of all stocks are responsible for the positive returns of the stock market. So you wind up having this gigantic right skew. So curiosity was, are there any similarities between Ford Motor Company in 1926 versus Levitt's Furniture in 1950, or Cisco during the 1980s, or Microsoft or NVIDIA today? And we scoured almost probably 100 different variables across not only fundamentals, but technicals and all kinds of volume. And when we laid everything out, the data came screaming back to us as to what the similarities between gigantic winning stocks happened to be, whether it was during the 1890s or 1925 or 1955.
You've got to tell us now, Arch. You've got to tell us now.
Well, that's part of the secret sauce of what we basically filter for, and a lot of it has to do with what we decide or define as our three factor sets. So there's fundamentals, which are present in every single big winning stock. It's probably about 90% of our inputs, but it's not fundamentals in terms of rolling our sleeves up and going to company meetings. We're looking at just the data. And a lot of it has to do with earnings, revenue, profit margins, things like that, return on equity. So we wind up basically ranking every stock from 99 being the best to 1 being the worst, and we're literally just chopping off the bottom 80%. We're looking for the top decile in terms of the best stocks out there. The second factor set that we're looking for is called more technical in terms of what is present in most of these gigantic winners. A lot of it has to do with our analysis of the volume and the accumulation on the long side, or the distribution on the short side. We can talk about the shorts as well in a little bit. We talk about relative strength in terms of really true leaders versus laggards that were present. So we found a lot of commonalities in that. And then the third component that we kind of also stumbled upon is the fact that we found that between 50 and 60% of a stock's movement is related to the subsector and the sector that it actually is part of. So we make that also a component of what we're doing. So we wind up creating a composite number out of all three of those factors. And so what the composite number does, it allows us to focus on companies that have phenomenal fundamentals, that are under accumulation, that are, from a relative strength perspective, leading the market, and that have great subsector and sector support. And that literally is the recipe for going out and finding fantastic, long ideas.
And this reduces your universe from, say, 5,000 US equities to how many would you get to after those three factors are applied?
About 250 names.
Gotcha.
Right. Which is usually about 10% of the 2,500 that get filtered out from the volume filter, right?
And so then how would you trade them once that scanning's all done?
Yep. So we like to look for bases. We like to look for stocks that are accelerating in earnings and revenue at a X% clip, that are going through a base period. It could be a 3 month, 6 months, 12-month base, but wind up basically breaking out on huge amount of volume that have.
So there comes your Davis breakout principle.
It's somewhat. And so what it allows us to do is create incredibly asymmetric situations where, we think of everything in terms of risk units. For us, simplistically, it's a breakout strategy, and something I learned from the turtles in terms of what kind of expectancy we can generate on the upside by being disciplined in terms of what kind of breakouts we're looking for, knowing that we have positive expectancy over a large sample size. We're not trying to predict the market. What we're basically saying is the fact that we've seen this happen thousands of times, and if we continue to do this over time, we may lose 60% of the time, but the 40% of the time that we actually are right will be massive, big winners, right? So if I can risk 50 cents to make $50, which is kind of that kind of asymmetry that we're looking for, I'm going to do that all day long. So when you look at the thousands of trades that we've put on, our hit rate is only about 40%. So we lose about 60% of the time. What's really encouraging is the fact that when we are right, we win close to about 4 risk units of profit, versus when we're losing, we only lose about half a risk unit of profit.
So you're getting lovely positive skew, lots of upside volatility.
Lots of upside. And so we wind up having kind of this portfolio construction mechanism where we have a pyramid of risk. So the first top of the pyramid is basically individual risk exposure. And again, we think about it in terms of risk units. We limit the amount between our entry and our predefined exit to basically set.
Are you using stops at all, Art?
We don't use hard stops. We use soft stops at all times.
Can you explain that a bit?
Sure. So when I first started back in November 2016, we did use hard stops. And we started to do the same thing that when I was down on the floor, I used to do to other people as well. The fact that during the first half hour, during the auction system, you knew where the stops were, where you went down to go hunt for them and stop them around and basically wheel the market around to the other side, right? And I was falling victim to the same thing that I used to do to other people when I was down on the floor. So we decided to use soft stops. We have a little wiggle room during the first, call it, hour. During the opening range of a lot of stocks when they get settled. So if I get a stop that pops up on my screens, we'll give it a little breathing room for the first hour. After that, if the stop basically keeps on flickering that it needs to get stopped out.
I see. So a soft stop is something that's not in the marketplace so everyone can see it, but gets applied effectively as a market order when that price level gets hit.
Exactly.
Okay, I'm with you.
Exactly.
Yeah, good way of stopping this, stop hunting, as you call it. Yeah.
Correct. And so for us, everything is at about a risk unit. For our flagship program, we risk 7.5 basis points of NAV on any single trade. So we call that a risk unit. We use ATRs in terms of understanding the volatility of how we position, and to answer the most important question that we find is how many shares to buy in order to actually kind of normalize that risk. So it doesn't matter whether we're buying NVIDIA or Google or a machine company. Every single bet is exactly the same in terms of how we think about it. We normalize risk. Everything is basically the same percent of capital that we're risking on every single trade, which is a very, very different thought process than the vast majority of guys out there that tend to be very subjective in terms of what they deem a great idea versus a medium idea versus an okay idea. People that think it's a great idea will go out and put 20% into a certain name. And when we look at the numbers, especially the types of data that we saw over the last 125 years, in the data that Besson-Binder looked at, that Critton didn't look at, the fact that I came to the conclusion, the fact that stock picking is incredibly difficult, with just a very small percentage of winners. So we took the opposite tack, basically saying, I want to throw my net out there as wide as possible, get as many names diversified across the board, because it'll increase the probability of me actually getting legged into a giant outlier. And so the key to doing that is basically having very small stops and getting stopped out frequently. And that's psychologically very hard for people to do, to literally take lots of small losses all the time. But it's
so lots of small bets is the key for wide diversification, catching those outliers.
Correct. Are
you leveraged here, Art? Are you leveraged in your positioning into stocks? Or are you buying them directly? What are you doing there?
So people define leverage all kinds of different ways. So you can basically take your long book divided by your NAV, or you can take your longs plus your short to come up with gross or net. So for our flagship, we don't use any leverage. For our partners fund, which is it basically runs 2x. So that's the way we think about the long book.
Art, do you?
Go ahead, Simon.
Sorry. I was just going to ask if you have do you have some custom built software or any particular software that you use for monitoring the positions and determining?
Yeah, we built everything ourselves out there. For us, it's all about the risk system. So for us, the second ladder of the pyramid revolves around subsector constraints and then sector constraints, which is the third level. So we restrict ourselves in how many risk units we can have per subsector, per direction. So we cap that. We do the same thing for sector exposure. So it forces us to do two things. Number one, it forces us to diversify out. But more importantly, it forces us to actually constantly weed small losses out at all times. So if I have, let's say, 5 risk units in semiconductor equipment companies, and I get another signal from a great fundamentally sound market leading stock that comes in, I'm going to look at the 5 holdings that I have, my 5 risk units, and if one of them is actually underwater, I will actually quickly chuck that one out and take the new signal. And that kind of goes back to how how Ed and a bunch of the other guys that mentored me in terms of thinking in terms of expectancy of signals. If you get a brand new signal, you wind up having a certain positive expectancy. If the trade starts to go against you, the expectancy of that trade signal starts to degrade against you. So what we're trying to do is literally having a portfolio full of really positive expectancy trades in our book at all times.
I quite like that. So effectively, you're at all points in time, you are looking at new signals and you're basically eliminating all of your small losses at that time. So you're keeping adverse risk very linear, small.
Correct. And
always sort of recycling your portfolio to eliminate all of the adverse risk events out of it.
Correct. Right. Constantly weeding the garden at all times.
Yes.
So, and everything that we think about is in terms of those expectancy of those signals. So if I put a position on, I know that I have certain expectancy of that signal. If it starts to basically go sideways or trade against me, like I said, that signal actually from an expectancy point of view starts to degrade and goes from, call it a +1 down to plus 0.75 to 0.5. And so that's how we think about it, is the fact that I'm constantly...
Oh, thanks for that, Art. That's very interesting. Yeah.
Yeah. So
in terms of the philosophy there, Art, like it's obviously something you're building to try and construct that positive skew. There's an aspect, if I understood correctly, of relative strength or cross-sectional momentum in there as well. There's a few different, I guess, philosophies underpinning that. It's not, say, a strict Richard Brennan style trend following philosophy only. There's a few things going on. Am I understanding that correctly?
Correct. So I'm not only looking at the Rich Brennan absolute or the absolute trend.
I'm here.
Ignore him.
I'm looking for the relative cross-sectional relative strength as well. We're looking to basically get into the leading stocks that are actually outperforming the market, that are also breaking out of significant bases that we think we have a great statistical edge in getting into. And then finally, the cherry on top is confirmation from the fact that there are institutional buying and great accumulation happening on the heels of it. So, Graham talks about having a buffer, buying cheap. Our institutional volume that's basically following us into it when we get these signals, that to me is our buffer. The fact that I know that I have huge institutional buying accumulation in back of me, there's probably not going to be, a surprise gap down lower. So that's kind of what we found in our research in terms of what is the kind of the extra edge that we have. So,
and what about on the short side? Sorry, Rich.
The short side.
No, go for it.
Go ahead, Rich.
No, please, Simon. He was talking about the short side.
Yeah, so the short side is kind of interesting. This kind of goes back to my days when I was at Man looking at the managed account data. I'll be honest, during my first foray into hedge funds when we were running one during the 90s, we were probably much more geared towards being a long-only manager. I found shorting to be incredibly difficult. Wearing my allocator hat, there are very few people out there that short very, very well. So when we were looking at this managed account data, that was one of my things that got me out of bed excited every morning to literally go and figure out how great people did on the short side and how they were doing it. What I came to the conclusion was the fact that the guys who were really bad were guys that were trying to basically sell the Roman candles that were trading, higher. They were trying to sell Tesla at 300, and then they were trying to reload at 400 and reload at 600 and reload. Those guys mostly got taken out and were horrible sellers. The guys who were really great sold down. So when something actually started to really fall apart, that was kind of eye-opening to us, is the fact that they were willing for something to actually have topped out, based, and then actually took another second leg down. And that's kind of philosophically how we think about it. So we're looking from a fundamental point of view, using those three kind of factor sets. We're looking from a fundamental point of view, degradation in terms of earnings, revenue, profit margins, things like that. So that kind of shows up on our fundamental screens. We look for almost the inverse from a technical perspective. We're looking for massive distribution of institutional money, and then we're looking for a classic breakdown both on an absolute and a relative basis from price action. And we're also looking for weakness in sector and subsector. So, I mean, I look at my short book right now, and we're really, really short a bunch of solar names because it's just a classic, sell short for us, along with a bunch of retail names and things like that. So it's a nice combination. We don't look at the short book as a hedge versus the long book. We look at it as a separate alpha driver in terms of what we're looking for.
And as much as possible, it's an inverse of the long in every sense that you can make it as much as possible. It seems that way.
Well, can you repeat that question?
It says, so the short is reasonably an inverse. You could say that it's an inverse of the idea of the long as much as possible. Might not be exact, an exact mirror image, but you're trying to make it fairly inverse of the long rules.
Yeah, pretty much. One of the exceptions that we use is when we put a short on, we want to have it make it, and again, thinking in terms of how we think about risk units, which we call R. Again, it's a concept that Van Tharp. I'm not going to put a short on, at least I have a really decent probability of actually having it go 10R in my favor. So I want to have the outlier, at least a 10R outlier potential for the short side. So if there's a $15 stock that's trading and it's got an ATR of 5, the most I can get out of it is 3R to the downside if it goes to 0. So we avoid those. I want to have the potential to make an outlier on the downside as well. So that kind of is one of the differentiating facts of how we think about the short side versus the long side. And most of the time on the long side, we don't deal in anything below $10. Just due to the fact that the vast majority of institutional investors out there really don't deal with smaller, anything below $10, it just seemed like. So most of the things that we're dealing with are, priced in, north of $100 in terms of big stocks. So that's pretty much the big differentiator, but you're spot on in terms of how we think about that inversely versus our long book.
It's interesting, when most people think of short selling, they typically try and short sell the very things that they've been previously trading long. And that's probably not the way to think about it, because, the things like the Teslas, the things like that have had this exponential growth, whilst most people think, oh, well, the rubber band's stretched, so they must come off, that's not necessarily the right assumption. So there'll be definitely stocks in that universe of the Russell 2000 or whatever, which inherently have a good opportunity for short bias, and they're not necessarily the same ones that have had the long bias previously. Is that what you've found, Art, when you compare the ones that you're going short against the ones that you're typically in long? They're not the same stocks?
Not the same stocks at all. Yep. And again, we are not in the prediction game. I don't want to predict, when the top at Tesla is going to be put in. I have no idea. I don't think anybody on the planet is very good at predicting. We play a game where we know where we have a statistical edge, and I stick to my knitting and manage my risk really well, and build something where it's second nature just to be able to pull the trigger and execute, which I think is the most important part of the entire process, right? So we try to keep it as simple as possible. To quote a very good friend of mine, Rich Brennan, the market is nothing but a complex adaptive system. So we try to go out and find as many very simple ways of trying to latch onto outliers as possible. And
gee, I wish I'd said that.
Wise man.
We've talked about one system. So with your 4 systems, can you just give us a brief overview of your 4 strategies?
Yep. So system 1 is the long
That's
system,
the long,
right? System 2 is the short. All single names, all again US, big, thick, deep liquid stocks. If I took a snapshot of my portfolio, we're agnostic to market cap. So we're going to go hunt wherever the hunting gets good. So if it's small cap leading the stocks, you're going to find that our long book is predominantly small cap. If it's large cap, we'll be large cap. Again, we're agnostic. We go wherever the hunting gets good. In terms of sectors, we're agnostic from a sector point of view. The only thing that we don't trade in is utilities, because when you go back historically and look at what percentage of gigantic outliers came from the utility sector, it's a big fat goose egg. So like, why bother? So we really don't, that's the only sector that we don't play in. In terms of regions, just US. So all single names for Model 1 and Model 2. Model 3 is philosophically built on the back of being able to make systematic the market profile concept. And it took me a long time to actually think through this and how to make it systematic. What we wanted to do was we wanted to be diversified from a time frame perspective. And so for us, we looked at all kinds of models using 5-minute data, 15-minute data, 30-minute data, 60-minute data, you name it, we looked at it. And I came to the conclusion, the fact that I wanted to build my own data set. So we wound up building something, a very customized data set that kind of strips time out. People call them range bars or Renko bars or whatever. We actually created a variation of a Renko bar that actually strips time out in terms of how we look at our data set. We trade 3 instruments. We trade the E-mini S&P 500, the NASDAQ 2000, the NASDAQ 100, and the Russell 2000. We only trade from the short side. And the idea is the fact that when the market literally starts to hiccup and roll over, our third model, which is more of like an overlay, kicks in, and we can literally hit the brakes, take exposure and net exposure and beta out of the portfolio, and pretty much neutralize the entire portfolio, our long portfolio. So our goal was to build a return stream that very much looks like a stair step. So when markets go into stress periods, we can easily, quickly take our exposure down. You go back and look historically over the last 7 years of any stress period, we've either gone flat or made money during those periods. It's fast enough to be able to actually strip off the hedge and re-engage when the market bottoms out and goes forward. So I can't tell you how many years that I've thought about how this thing would be put together. Spent a lot of time talking to the guys that all traded market profile with me. Talked to guys like Buzzy Schwartz, who wrote that book called Pitbull, Mark Fisher, Jim Dalton, you name it. And we came up with something that's just incredibly unique. As an allocator, I've probably been in meetings with 2,000, maybe 3,000 hedge funds. I don't know any hedge fund that actually has anything remotely close to this hedging model. So it's just very different in terms of how we can literally hit the brakes and hit the release valve really quickly and take our exposure quickly out of the box.
I like your stair step analogy, which is different to those seeking smooth equity curves. You're looking for the stair step, the positive acceleration.
Correct. So so that's model number 3. Model number 4, we just introduced
on number 3.
Sure.
So it's fairly short term then. The holding period, say, of those trades is actually a couple of days, or?
Well, it's kind of interesting. So we actually chop it up into different tranches. So we have 8 tranches. So as the market starts to move lower, we'll get additional tranches. There is always 1 or 2 or 3 tranches on at all times. It's when the market starts to roll over. And this past month has been a classic example. Usually when you get an accelerated downturn becomes, and Simon, you may recognize this language, it's a one-time frame market, right? Sellers are completely in control of the market distributing lower, and it's basically just an Acapulco cliff dive. It's just one way. We usually get completely hedged up probably within 3 days of a top. If the market starts to go into a one-time frame auction process lower, we're probably hedged out within the 3rd day of the top. And during the month of September and October, we actually were positive for the month. We basically participated at the beginning when the market, beginning of the month when the market rallied, and when the market started to roll, we literally just hedged ourselves out, and the market literally just went, straight down after that. So from a holding perspective, we have been basically with our hedge for probably about the last 20 days. and we've been hedged out. At the same time, our long book is slowly getting stopped out because we use the trailing stop mechanism from that perspective. And so we have to manage our hedge book. So we start to take in some of our hedges basically to make sure that our ratios are pretty constant as we're basically going through that liquidation phase of the long book. So
strategy 3 stops the bleed. It's your fail safe.
Strategy 3 is what I consider our secret sauce. It stops the bleed. A lot of guys out there try to use options, and they have some kind of optional overlay at all times, which I was never in favor for. Most of the guys can't trade options very well. Again, it goes back to that time period when I was down on the floor of the exchange and having that exposure of having amazing traders, that I was taught from. It just gives just an experience that it just can't be delivered to the 28-year-old analyst who is doing fundamental work. He has no idea how to trade around a lot of these things and look for how markets are distributing themselves and understanding how markets truly work from that floor experience. So I've been beyond fortunate to have that opportunity set and finally figure out how to integrate it into what I built.
For the future listener, I'm just going to give the context too of when we talk about the last few months. So it's currently the 8th of October 2023, or at least at this end of the world, it's the 8th.
Right.
Already.
Yeah. So then the fourth model, which I built, again, thinking about it for eons, I was always fascinated by the low latency strategies. It wasn't something I was comfortable with, but I always found it fascinating in terms of what they did down at that time frame. And again, it goes back to my mentors. You need to basically be very comfortable in building your own methodology that's comfortable for you. So I wanted to basically hunt down there to start figuring out ideas, started putting all kinds of ideas to programming and back testing and things like that. And when I was down on the floor, I kept on seeing this anomaly that happens during the first, call it 90 minutes of, again, back during the dinosaurs, during the 80s and 90s, the fact that when locals actually started to, do the opening range and basically establish it in terms of how we thought about it from a market profile perspective. And I figured something out that literally, I just still question why this anomaly still works in terms of this bizarre anomaly as to how the market auctions itself in the first, call it 90 minutes to 2 hours.
I'm listening hard.
And so we built basically this scalping method that we've put to work. It's now up and running for about a year. That takes a certain number of S&P points out of the market on a daily basis and then shuts itself off. And so it allows us to kind of create a ballast in the portfolio on this, call it semi-low latency. I don't even know if that's a term, semi-low latency time frame that we think is a really great diversifier in the book. The problem is it's a little bit capacity constrained in terms of doing it. We think we could probably run maybe about $400 or $500 million doing that, but we'll see. But it's completely differentiated. It's a new gear that we have in the gearbox, and our return stream proves the fact that it's just been a phenomenal addition to what we've done with the other three models. So
this requires a bit of heavy IT there, Art. Is there a big barrier to entry for people that want to play in that low latency game?
A little bit, yeah. I don't think a retail trader can do that. So there's a little bit of a hurdle from an IT perspective in terms of what we built, but it's well worth it to roll your sleeves up and find out
Build that out.
find out how to make that work.
That's just
so how do
trading
these four
safe.
come together?
Sorry, Rich, if I just can clarify, that stage just trading the the E-mini futures, is it?
Correct. It's just trading futures. Correct.
Okay. Sorry, Rich, go for it.
I was just going to say, so now let's bring them all together. What sort of allocations do you have to each, and how do you blend them all? And is this an all-weather strategy, what you'd regard as an all-weather program when consolidated together?
Again, it goes back to my time as an allocator and what I thought was missing in the equity long-short space as an allocator. Like, okay, what do I really want, and how do I want to allocate to my money for my clients as an allocator, especially when I was at Man Group. And what was missing was a absolute return, a true absolute return, all-weather type of product. So the way I thought about it is the fact that most people think there are three regimes in the market, up, down, or sideways, when in reality I think that, or my belief, is the fact that there are really six. So you can have up smooth or up volatile, same for sideways and down. So now
that was Van Top 6. He had six, I think.
That's Van talking out of my mouth, right? So we wanted to build, and again goes back to Van, as many uncorrelated return streams that no matter what regime you were in, you were going to be able to literally make really nice profits. And that's the philosophy of what we're trying to achieve. So if we're in a great bull market like 2017 with low volatility, model number one is going to do all the heavy lifting. Our short book kind of did okay. Our hedge model was, for all intents and purposes, shut off or operating at 25% capacity. And at the time, we didn't have the fourth model on. But come fourth quarter 2018, the long book was basically pretty much neutered. Our single name shorts did phenomenal, and the hedge book basically did all the heavy lifting. So it's kind of like having different levers being turned on and off as we go through the cycle, and that's how it's built. And it's
what's determining the strength of the levers, like what the allocations to each? What's determining that?
The market itself. So our systems adapt to kind of price action, volatility, things like that. So
okay,
that's how
the signals themselves in a particular favourable regime will be more active in one than another. So that's naturally dynamically adjusting it. I'm with you. Yep.
Yep. So it's always interesting to, again, wearing my allocator hat, looking at managers that, especially in the equity long short space, that will keep their net exposure or their gross exposure constant throughout any regime. And that to me is just insanity. It's like, I don't get that. We want to basically have as much variable net exposure, gross exposure as possible, because you need to adapt to what regime you're in.
Yep.
One question I have about using, so in the first two models, but as well as in that, particularly in the third, in all of those models, there's some complex inputs that would be hard for the retail trader to backtest. Do you actually backtest in the traditional sense, especially taking some of those fundamental inputs and actually putting that data into the engine over the last 20, 30 years or whatever, and do it that way, or have you got other techniques?
So I haven't backtested Model 1 or Model 2 in like the last 20 years because I've been using them so long. The fact that there's no reason to do a backtest. They're live.
Track record.
Yeah, they're live. So I spent a lot of time with the guys at William O'Neill who have phenomenal databases that have done some of the backtesting for that, especially kind of on their earnings and revenue rating and some of the relative strength. So I have piggybacked a lot off of their work, and then did a lot of the backtesting on kind of the absolute and relative strength breakout systems as well. So the fundamental data was a lot of back testing that was done years and years ago. There's no reason to basically for me to run back tests anymore. The fact that it's just, I will pass this on to my sons, my two sons, and they'll be using it hopefully in the next 30, 40 years, because it's common sense. It just works. And it's been working.
It's a great way to answer the question about how you avoid curve fitting.
Exactly. Yeah. Exactly.
And then, to what extent then have the strategies changed then? So you've really had these same principles in your mind over a long period of time. You've been prop trading, you've managed funds, you've had experience in futures and in equities and in different areas. You're trading over different time frames, but you've had a fairly static philosophy and set of principles there that have driven these particular strategies over a long period of time, it sounds, which is fantastic. But have they developed much? Have they, what's your process for working out when you need to enhance them, or how you research to enhance them?
So I think out of the models that I've employed, the one that I've probably made the most change to has been the third model. And it wasn't a matter of changing the signals. It was just a matter of actually going from 4 tranches to 8 tranches. And it happened, I guess, in the second half of 2018. What we found was the fact that we were getting whipsawed too much. So we went back to the drawing board. Had nothing to do with signal generation. It had to do with how we thought about from a sizing perspective. And so we kind of ran back tests on how we tranched into it. And we basically doubled the number of tranches from 4 to 8. So it created a smoother return stream for us. It caused a little bit of lag in terms of getting some of our shorts on when the market kind of just really started to accelerate to the downside. But overall, it basically eliminated a lot of the whipsaws as well. So that's pretty much the most kind of major tweak that we've done to any of our models. Over the last, God, I've been running models 1 and 2 for the last basically 30 years.
Wow.
So that's
a bit like Jerry Parker, Paul Mulvaney. They've got this model in place, stands the test of time, very little tweaking.
That Marine down in Florida, Mr. Dunn, he's been running the same models for since the 50s or whatever. So we're just trying to take advantage of what we think are just behavioral patterns that occur and will continue to occur over and over again. I think Curtis actually had a great analogy in terms of thinking about breakouts, Curtis Faith. And he talks about in his book all the biases, so recency bias, anchoring bias, disposition bias, whatever. He said when you actually get to a certain breakout period coming out of a base, it's this war between one side versus the other of that biases, and they are pretty quickly going to determine who the winner is. It's going to be one party versus the other. If it's the losing party and you happen to take on a losing trade, pretty quickly, if the bias that you think is going to collapse, winds up pushing back against you, so you could take really small little losses. If the defense basically folds and it winds up being a great breakout, you'll know that pretty quickly as well. So I always found that line pretty interesting that Curtis had, the fact that incorporating that behavioral bias as to why breakouts happen and why trends happen, and that's, as Jesse Livermore said, it's speculation is as old as the hills and will continue to kind of perform the same way, in my belief. That's kind of how we built our systems. We're literally geared to take advantage of those behavioral biases that keep on occurring over and over again.
I love the fact that there's that that common sense framework. There's even that experience in discretionary trading and market profile and everything. And you've tried to then systematise that, put rules around that, build that because you know how the markets work, how people work, what should actually generate profits, code for that and let it run. And that leads me to a question of how automated is this now then for you? Do you actually put trades on yourself, or is the whole process automated?
So I would say that if I had to build a pitch book, I would have to say it's rules based as opposed to systematic. And I'd say that the exception to being fully rules based is number one, not having hard stops in, like we discussed. So we don't have our orders in for models 1 and 2. Models 3 and 4, that's all systematic in terms of how that gets generated. So that's that. The other kind of, I guess, discretionary part of how we think about things gets back to, call it a risk budgeting question. So, for example, if I'm long those 5 semiconductor equipment companies and I get a new signal, I may have one position that is slightly showing me degraded expectancy. And the question is, do I boot that guy out, or actually do I take the new fresh signal? And so that's kind of a discretion. What my general fallback in situations that are pretty gray is I don't want to commit a type 2 error ever. The fact that was taught to me a long, long time ago. Never commit a type 2 error because you may miss one of the biggest outlier winners out there. So I will put a half a position on. I'll actually take half a position off out of the position in my portfolio that's kind of degrading, but I'll actually have a half a unit on for the new position. So I keep my overall risk exposure per that subsector identical to it matching up to the risk constraints that I'm abiding by, but at least I'll actually put something on to not commit a type 2 error. So that
so type 2 error is missing the trade, is that right?
Missing the big fish.
You never want to miss the big fish, and you never know when the big fish is going to show up, right? So that's something that we apply more of a discretionary feel for. Missing the big fish could be detrimental to a year's P&L, and you never want to do that. So what happens is if I put a half a unit on and it continues to go in my direction, I'll pyramid into it for it to make a full unit of risk into the book. So at least I have a full unit if it winds up turning into a big fish. So that's the way we think about it.
Okay. We need to start wrapping up. So have a think about whether we've missed anything that you want to cover. And Rich, do you have any questions outstanding?
Well, I'd just like to say that we know that Linus is coming onto our podcast very shortly, and I know that you've got a history of Linus art, so we're going to give you the opportunity first to get in with your comments about Linus so that when he refers to you, you'll have the edge.
So Linus is one of my favorite people on the planet. We started at Man Together on April Fool's Day of 2008. We both walked into the office. We both have a love and passion for this business, especially both of our backgrounds coming from the CTA side. So in terms of systematic research, and we could go on and on for hours over drinks talking about all this stuff. So we're both incredibly passionate. He's going to be a great, fantastic guest for you guys. He's got so much knowledge and experience in the space. So he'll be great for you.
That's great.
Yeah. So other than that, I think we covered a lot of ground. I hope some of it was good fodder.
I think it was all. It was brilliant. Actually, I had one other question that just sprung to mind, Art, and that is the fact that you do trade futures and equities differentiates you a little from many CTAs. Is that, how uncommon is that, do you think? Is there much of an edge in that?
So it's actually kind of interesting, because when I initially wanted to launch Breacher, I wanted to build something that did both, basically traded single name equities and then traded orange juice and nat gas and currencies and fixed income. And I thought it would be a unique product. And I went out to my friends network and kind of threw that idea out to them, and they all came back and basically said, well, it's a great idea, but it's going to be difficult to be able to raise money doing that. And the reason why is the fact that most institutional investors want to put you into a box. So, for hedge funds, categories are pretty distinct. Either you're an equity long short guy, or you're a CTA, or you're a merger arb manager or a convert arb manager. And by going down that path of trading single name equities plus the futures, a lot of people just wouldn't know what to do with you. So from a business perspective, we decided to basically scrap the single name, the futures, and just go with the single name equities and become kind of a very different equity long short manager, because we utilize some futures, which are just the ES, RTY, and NQ, but it was just an easier story to tell. I think it's great. I wish I could do it, because I see some players out there that are starting to go down that path, and I'm kind of jealous. So I think it's a great diversifier, and it should be a great product. It's just a matter of trying to convince institutional investors that that you should be in a separate box.
Okay. So anything else, gents? Because I think we have covered a lot of ground. It's been a fascinating trip down through your history, all the experience that you have, how you've brought that in. I love the thought that you've tried to quantify market profile. That's going to give me something to think about. Having, been in the market profile camp when I was trading futures just for myself on a discretionary basis many years ago. And I loved the concept, but since being systematic, it's gone off my radar, really. So that's fascinating, and I love the fact that you've got that diversified ensemble of systems too, where you're really seeking to do what works, what makes sense, and bring that all together in a really highly diversified way. And the proof is in the pudding, in that history that you've traded over the last 30 plus years. So I think it's been a really interesting journey.
Well, thank you.
It's always a pleasure to chat with you, Art.
Absolutely. Again, thank you for thinking about me. Thank you for having me on. I look forward to Linus's interview, and actually all your interviews so far. I've watched all of them, and they're fantastic. You guys are doing a really great job.
Thanks, Art. Thank you. We're getting better as we go, we hope.
All right, great.
Awesome. Well, it's been a real pleasure, and we thank you very much for coming on. Hopefully we'll see you again sometime. We'll check in with you, and until then, all the best.
All right, great. Thanks, guys.
Thanks, Art.
Cheers. Bye.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky, and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.